Good morning, and depending on where you are, good afternoon. Thank you for tuning in to our nine of 10 pillar. This is webinar 9 of 10 of the Pillar 2 technical series that we have been running since last year at this point. And our session here is coming to a little bit of an end, but we do want you to stay tuned that there may be another one in the works here in the near future, so please stay tuned for that. So just a high level overview. Last week or last session we discussed the GLoBE reporting and compliance, basically the GLoBE information return. Today we're going to talk about taking some of the concepts that we went through in some of these prior sessions and combining it and really taking a more deeper dive into Article 6 of the model rules. So, but before we go into that, I would like to, for those that haven't tuned in, my name is Justin Metcalf. I'm a director with the Charlotte, North Carolina office of Forvis Mazars, and I will let my colleague here introduce herself as well.
Thanks, Justin. I'm Carolyn Boschman. I'm a managing consultant with the Forvis Mazars US office. And for those of you who have been with us since the beginning, you may recognize me from the second session. So thank you for sticking with us and hoping for a good session today.
Thank you, Carolyn. And just so today we're gonna talk about a number of things. So we have an agenda here, and last week there was quite a bit on the Pillar 2 front, with given the new U.S. presidential administration that came in, and I think a lot for a lot of people there was a lot of news that popped about what the course for the U.S. is. So we've decided to take a little bit of a pivot today to start off the session before we do a recap to kind of go through some of the items that have been thrown around with the current Trump administration. So, so we're going to go through that, and then we're going to go through a quick recap, and then we're going to go through an overview of Article 6, and then we're going to kind of go piggyback to the elections presentation where we discuss some of the pieces there that really filter into the M&A space with respect to Pillar 2, and then we're going to wrap it up from there. So, to kick this thing off, I'm going to kick it over to Carolyn here to kind of take us through, what was the news that dropped last week and what could be those ramifications. So, Carolyn, take it from here.
Thanks, Justin. So we've been working closely with our colleagues in our Washington National Tax Office to stay informed of the latest legislative updates and executive guidance around Pillar 2 and their stance on the global tax regime. So President Trump was inaugurated on Monday, and in his first day in office, he issued a number of executive orders, 2 of which contained provisions that were aimed to address the U.S.'s stance on the OECD's global tax regime. So the first executive order was titled the Organization for Economic Cooperation Development Global Tax Deal, a little bit of a mouthful, and it provides that the Pillar 2 regime will have no force and effect in the United States. And it also authorizes the Treasury to develop options to address foreign countries that enact tax laws that are extraterritorial in nature, disproportionately impact U.S. companies, or impact income tax treaties. So it's a pretty broad scope. The order calls for the Secretary of the Treasury to deliver their findings and recommendations to the President within 60 days. So we're going to be watching closely for this update. The second executive order was titled the America First Trade Policy, and it contained a number of provisions, but importantly, in subparagraph J of Section 2, it called for the Treasury, along with the U.S. Commerce Secretary and U.S. Trade Representative, to investigate whether any foreign countries impose discriminatory or extraterritorial taxation on U.S. citizens and corporations. So notably, the order references Section 891, which was enacted in 1938, that calls for a doubling of U.S. tax rates on foreign citizens and corporations should the president find that citizens or corporations of the U.S. are being subjected to discriminatory or extraterritorial taxes under the laws of any foreign country.
And just before we go into that, I think that's pretty significant right there from a and who knows where it goes from there. But to add color to that, Section 891, to our understanding, has never been actually. So it requires that the president of the United States to formally invoke it, and to our understanding, it has never been invoked in the history of the country. And there aren't many regs on that. So we would have to, I would say we're heading into a territory where, there could be maybe more regulatory action, but there is the freeze going on right now, so we really don't know. But I think for those that are, this is one where there will be a lot of chatter back and forth, and I think there will be a lot of development on this. So stay tuned for what could evolve there.
Yes, thanks, Justin, for providing color there. It definitely would be a drastic measure to invoke Section 891. So noting that that first executive order would call for remediatory options in the next 60 days, we turn our attention to legislation introduced in the House Ways and Means Committee, titled Defending American Jobs and Investment Act. And this act would impose an additional tax of 5%, increasing up to 20% over the next 4 years on the U.S. income of wealthy foreign investors and corporations in jurisdictions that have enacted these extraterritorial taxes, such as the UTPR, which is one of the charging mechanisms of Pillar 2. So while this 5% increase that we're looking at in this legislation may not be as severe as a doubling of the tax rate under Section 891, it could still have severe consequences for citizens and companies that do business in the U.S. A lot of jurisdictions are set to enact a UTPR in 2025, namely Canada, France, Germany, the Netherlands, UK, among others, just to name a few. And despite the posturing by the US on this Pillar 2 regime, the UTPRs enacted in these jurisdictions could still impact US parent companies that have subsidiaries operating in these jurisdictions.
And I would add also, I think what we just from the recent couple days, I saw that Indonesia, just enacted Pillar 2 into their laws. Sorry, they enacted regulations that would basically put Pillar 2 into action, and part of it was including a UTPR. So it does seem that there is no kind of there is no scaling back right now on the rhetoric and the what's being thrown around with the UTPR. So it's something to monitor. So sorry, Carolyn.
No problem. Thank you for providing that insight. So the OECD, they are aware of the US's reluctancy and at this point seemingly downright refusal to adhere to the global tax deal. And they've actually provided a transitional UTPR safe harbor that applies through fiscal years ending December 31st, 2026. And this would eliminate any UTPR top-up tax liability if the ultimate parent entity of a multinational group is located in a jurisdiction with a statutory corporate income tax rate of at least 20%. So note, this is the statutory corporate income tax rate, not the effective income tax rate. So with the U.S. having its statutory rate at 21% right now, should U.S. companies that are UPEs and multinational groups should qualify to the extent that that statutory corporate income tax rate is not reduced. We want to, of course, note that there have been talks of reducing that statutory corporate income tax rate to 15%, but at this point, that's really uncertain. We can't really say which way the administration is leaning on that. I don't know if Justin has anything else there on the impact to Pillar 2, but we did want to touch on the stance of the U.S. on Pillar 1. So it's not clear if these executive orders will impact the OECD simplified and streamlined transfer pricing rules for those certain marketing and distribution transactions, the Pillar 1 Amount B. The IRS had informed taxpayers previously in Notice 2025-04 that they could rely on those transfer pricing safe harbors with some modifications beginning in tax year starting January 1st, 2025. The IRS suggested that they were intending to issue proposed regulations that were in line with the OECD's Pillar 1 guidance. However, to Justin's point, we do have the regulatory freeze in place, so it's pretty unlikely that this guidance will be forthcoming in the near future. So I think that's a pretty good overview of where we are today in light of last week's events. So in the interest of time, I think we probably want to go ahead and pop up our first polling question here. So for those of you who are involved with companies that are subject to the Pillar 2 rules, that may be subject to the Pillar 2 rules and have a UPE in the United States or elsewhere, do you think that they're going to satisfy that UTPR transitional safe harbor, looking to the jurisdiction of the UPE, and if that jurisdiction has a statutory corporate income tax rate of at least 20%?
And, I guess while we're waiting on that poll question, there's a good question right here of what weight of law do these executive orders hold? And, I think, the president's order is, the president's job is to enforce the laws of the United States. Congress makes the laws. The president's job is to execute those laws. I think the executive order certainly carries weight as far as, the direction where the U.S. is going. But, as we know how the Pillar 2 rules work right now, like specifically because of the UTPR, it really doesn't. I don't know if it really matters whether the U.S. has backed out of it or not. Now, if there is the threat of tariffs or withholding tax imposed on UTPR jurisdictions for them collecting on the U.S. on that, I think that might have some weight right there. But right now it certainly seems like we're kind of headed to this tax conflict between the OECD and the U.S. But I'm not one to speculate, but we'll have to see where that goes from. So it looks like quite a bit are said yes, and some are not sure. So we'll have to look at that. So taking a step back from our detour, right now we're going to talk a little bit about Article 6, right? So, but before we do that, let's do a quick recap. So, I mentioned earlier in our when we were doing the polling question that we don't know the UTPR is here, right? And that basically gives countries the ability to deny enough deductions in their own jurisdiction. I mean, in their own jurisdiction to basically top up any delinquent jurisdictions in their M&E group. So, in previous sessions, we talked about the charging mechanisms, and that's kind of what the, IIR and UTPR kind of are premised on. So, Pillar 2 is set up as, everybody is subject. The foundation of Pillar 2, right, is set up where everybody in an M&E group is subject to Pillar 2. It's just a matter of who gets to charge the tax on behalf of that, and that's really based off the QDMTT, which is a local country law, right? That tax law that basically imposes top-up tax only for that local jurisdiction. Then there's the IIR and UTPR, which kind of play off of each other. The IIR starts at the top of the house and says, hey, if somebody at the top does not have a qualified income inclusion rule, we go down a tier until somebody does, right? And that person, if you go down a tier, gets to collect on behalf of the entities that are low tax below it. UTPR is basically saying, hey, anybody in the group that has not been topped up or is subject to a top-up tax liability and just didn't get brought into charge to the QDMTT or the IIR, basically what happens is any jurisdiction that has a UTPR gets the ability, through an allocation mechanism laid out in Article 2, to deny enough deductions to top up that other jurisdiction. And in prior sessions, this one top-up tax liability is dictated by this formula here, and I'm sure everyone here has heard it, so we won't spend too much time in that in the interest of getting into the material. But for your reference, right, everybody has to figure out their jurisdictional top-up tax liability, and this is kind of the formula that determines that liability by jurisdiction. So. And once that top-up tax liability has been determined, then is when the IIR, QDMTT, and UTPR come into effect. To figure all this out, we're going to have to, today we're going to kind of take a rewind back to one of the very first sessions of, understanding the M&E group, right? And this is kind of, in one of the first sessions of this 10-part series, we had this framework laid out on how to tackle the Pillar 2 rules through a step-by-step process. Today we're gonna investigate and analyze how certain crossover rules from Article 6 play into figuring out who the M&E group is, and we'll even cascade a little bit into step 2 and step 3. When you do have a transaction, what does that mean for GLoBE income and loss perspective, specifically when you transfer assets and liabilities? So without further ado, let's go back and just rewind. I'm going to kick it back to Carolyn here to take us through some of these definitions for the M&E group before we go into the full scope of Article 6.
Thanks, Justin. So Article 6 is going to deal with rules regarding the treatment of mergers and demergers and their impact on an M&E group, as well as adjustments that are needed to our calculation of GLoBE income or loss. So before we get into that, it's definitely good to go through a refresher of some of our definitions. So an M&E group is any group that includes at least one entity or permanent establishment that is not located in the jurisdiction of the ultimate parent entity, or UPE. So a group is a collection of entities that consolidate in consolidated financial statements of the UPE, or they're excluded only based on size or materiality grounds, or that the entity is held for sale, and that entity is located in one jurisdiction and has one or more permanent establishments located in other jurisdictions, as long as those entities are not part of another group. We have entity, which is any legal person other than an individual or an arrangement that prepares separate financial accounts, such as a partnership or trust. And here it's important to note that if they're with the trust here, there's a little bit of a lack of guidance around whether that can be considered an entity. But an entity is not considered the UPE of the group if there's another entity higher in the ownership chain that is required or would have been required to consolidate on a line-by-line basis. So a constituent entity is an entity that is included in a group. It can be a permanent establishment. It cannot be an excluded entity. So those governmental organizations and non-for-profit organizations will not be considered constituent entity, given that they meet certain requirements. The ultimate parent entity is going to own directly or indirectly a controlling interest in any other entity, and it's not going to be owned with a controlling interest directly or indirectly by another entity. Or it can be the main entity of a group that owns one or more permanent establishments. So I think the key here is that before a group can be considered an M&E group, the UPE must have directly or indirectly at least one subsidiary or permanent establishment that is located in a jurisdiction outside of where that entity is incorporated. A single subsidiary or permanent establishment, even if it doesn't earn income, if it's located in another jurisdiction, that's going to be sufficient for those two entities to meet the definition of an M&E group. And it's important here that we define the M&E group because only M&E groups are going to be subject to the GLoBE rules. You've heard us talk a little bit about controlling interest. It's an ownership interest in an entity such that that holder is required to consolidate assets, liabilities, income, expense, cash flows on a line-by-line basis, or it would have been required if it had prepared consolidated financial statements in line with an acceptable financial accounting standard. And finally, we have permanent establishment, so a place of business or a deemed place of business in a jurisdiction, and it's treated as a permanent establishment in accordance with a applicable tax treaty in force. And then we also have joint ventures. So I know that we've covered joint ventures in great detail in our session with looking at complex M&E groups. So JVs may not be considered constituent entities of an M&E group because their income, expenses, assets, liabilities, et cetera, may not be consolidated with the rest on a line-by-line basis. However, low tax income may be brought within scope of the GLoBE rules under the equity method if it's consolidated into the financial statements of the UPE, and that UPE holds at least a 50% ownership interest. So generally, if it doesn't meet those requirements, we'll see joint ventures be considered their own M&E group, and then we can see further entities that they own, JV subsidiaries and a JV group. We can see that compromise its own JV group that could be considered its separate M&E group to the extent that it has holdings outside of its jurisdiction of organization. So I think that is a pretty good overview of our definitions there. And I think that sets us up well to go into Article 6 to start talking about the effect of mergers and demergers on our M&E group determination.
Thanks, Carolyn. Yeah, and great run through there. And JV groups are always a tricky one there because they really are treated like an M&E group within an M&E group. So those with JV groups, should probably give a lot of deference to the Article 6 rules on that front. So let's go through a quick overview of what Article 6 says. So Article 6, right? There's a plethora of guidance on what it covers, right? So it discusses the consequences of transferring part or all of the controlling interests or assets and liabilities of a target constituent entity. It talks about how you treat the consolidated revenue threshold, right? That under Article 6.1, which we'll talk about here in a second. It also it provides rules for how you apportion GLoBE income and covered taxes, between a seller and a purchaser. There's again rules on JV groups, how those are treated, and quite a bit on the multi-parented M&E. There's how do you treat GLoBE income from the context of a multi-parented M&E group, and we I think in our prior session we also covered that. I don't know if we'll be able to cover all of this today, but we're gonna highlight some of the key points that we haven't discussed in prior sessions. So without further ado, right, let's talk about the consolidated revenue threshold. So, as we all know, you're in Pillar 2 if your M&E group in 2 of the last 4 fiscal years has euro 750 million or more, according to the consolidated financial statements of the UPE. That's deliberately in Article 1. But before we go into that, I think it's important to understand that. But before we go into that, for purposes of CPE, let's do a polling question here before we dive in. So has your company's M&E group acquired a new constituent entity in the past 12 months? Yes, no, or not applicable. And while we're waiting on the results here, in the next segment here, we're going to kind of go through different scenarios about mergers and demergers and how that's treated here, specifically in the context of an M&E group and how that interplays. So let's see, give us time. So a lot of you said no and not applicable. Okay, good to know. So yeah, so let's pierce a little bit into Article 6.1. Right. So as I mentioned earlier, right, the testing threshold is in 2 of the last 4 fiscal years, you have to have euro 750 million or more. Now, what happens though when you acquire an entity or you basically spin off your parts of your M&E group into different groups, right? And that's what Article 6.1 is really talking about. And it talks about 3 specific scenarios, right? It talks about where you have 2 or more groups that merge to form a single group in any of the 4 fiscal years prior to the tested fiscal year, right? It talks about an entity that is not a member of a group that merges with an entity or a group that is in its tested fiscal year. It talks about an M&E group within the scope of the GLoBE rules where it demerges into 2 or more groups. And we'll go into what the definition of merger and demerger is for purpose under the OECD's eyes on the model rules here in a second. So let's go for the first one where you have a merger between 2 or more groups. So Article 6.1.2 defines a merger as any arrangement where all or substantially all of the group entities of two or more separate groups are brought under common control, or an entity that is not a member of any group is brought under common control with another entity or group to form a combined group, right? So what the model rules say in this, and we'll go through a quick example of how that works, right, is if two or more groups merge to form a single group in any of the 4 fiscal years prior to the tested fiscal year, then the consolidated revenue threshold of the M&E group for any fiscal year prior to that merger is deemed to be met for that year if the sum of the revenue meets the posting threshold of equal to or greater than 750 million euro. So let's do a quick example here. So, you know, we have Group A and Group B, right? And let's say Group A and Group B merge together, right, to form A, B, M&E group, right? As you know, the definition of merger doesn't really distinguish between how how the entity is acquired. It just basically says they've been combined together, whether it's through like in the U.S. context, we think about it with the tax-free reorgs or an acquisition, right? This is just very broad to encompass any kind of combination. So in our facts here, you can see Group A and Group B, standalone do not meet the posting threshold, right? Group A hasn't made 750 million euro in any year, and neither has Group B. But when they combine in year 5, right, the year of the merger, Group A and B basically merge to be A B M&E group, and as you can see, they will be within scope of Pillar 2 because they had 800 twice in the past 4 fiscal years. So that's kind of a quick, easy example of how this 6.1.1 example comes in. Let's go into the next piece here. So when you have, let's say now you have a merger between a standalone entity and an entity or group, right? So what the model rules say is when an entity that is not a member of any group, let's just call it the target, merges with an entity or group, the acquirer, in the tested fiscal year, and the target, acquirer, or both do not have consolidated financial statements in any of the 4 fiscal years prior to this tested fiscal year, because it just, let's say it wasn't a member of that group in that year, the consolidated revenue threshold of the M&E group is deemed to be met for that year if the sum of the revenue in each of their financial statements or consolidated financial statements, key in the would-be test, right, for that year is equal to or greater than 750 million euro. So let's do another quick example here to parse through that. So, here we have, group A-co and B-co all in 2 different jurisdictions, right? Let's say one of those jurisdictions is in Pillar 2, right? Because that's an assumption here. Let's say in year 5, A-co buys B-co and basically creates now what we're calling A-B M&E group, right? Again, keep in mind, none of these standalone have ever been in Pillar 2, right? Because A-co, while it's been trending on the on that happy medium, has never hit the 750 million euro threshold at 600. B-co, however, has been almost half of that. So A-co makes a massive acquisition, and what you're seeing here is now AB M&E group now have to combine their revenues in this testing threshold, and standalone they wouldn't have been in here, but combining it all, now they're what we call in the soup, right? They would now they meet all in the past 4 years, right? They've hit $1 billion of euro. Yes, so in year 5, because all 4 preceding fiscal years had consolidated revenue of more than 750 million euro, we now have to think about Pillar 2 going forward for this M&E group. So that's in the context of combining groups. Now let's talk about demerger, right? So this sounds very similar to those that are in the spin-off land, right? Where you create you know, you take some entities and throw them out of your M&E group, and they form their own. So let's talk about what 6.1.3 defines as a demerger. So under the model rules, they classify it as any arrangement where the group entities of a single group are separated in two or more groups and no longer consolidated by the same UPE, meaning we have two different UPEs of two different M&E groups. You know, what the rules say on this is a demerged group is within scope of the GLoBE rules if it has annual revenues of euro 750 million or more in the first tested fiscal year after the demerger. In the second and subsequent years following demerger, a demerged group is within scope if it meets basically the testing threshold of 750 million or more in at least two of the fiscal years following the demerger. So that one transition year is a key piece when you're thinking about a demerger, because it can kind of throw you right in if you're not paying attention. So let's do a quick example here to take this home. So, you know, we have A, B, M, and E group, right? We created them in our last example, and now we're gonna rip them apart here. So, in year one, A group distributes group B to its shareholders in a transaction treated as a demerger under Article 6.1.3. Here in year one, A group will be subject to the GLoBE rules because its consolidated revenue for the first fiscal year following the demerger exceeds 750 million euro, right? And you can see that right there. It's at 800, right? In year two, A group is subject to the GLoBE rules because its consolidated revenue for two of the last 4 fiscal years, year 1 and 2, have now exceeded 750 million euro. So in this assumption, right, the demerged ACO continued its consistent path of 800 million euro or more. Notably, though, you know, B group is not within, right? B group is out, right? So, you know, this is kind of just a pragmatic look at how this consolidated revenue threshold is treated under 6.1.1 through 6.1.3 of the model rules. So with that said,
could I add something here? The fact that the demerged B group is out is notwithstanding the fact that it is not joining another M&E group where it would meet the consolidated revenue threshold test. I think this example considers that the demerged B group would be on its own and therefore not subject to the revenue threshold test, but it could be within the scope of GLoBE rules to the extent it was joining another M&E group that met the consolidated revenue threshold and met the definition of an M&E group.
That's a great point there, right? So, like, you know, I think merger and demergers in the context of the group you're looking at it. So, you know, if B group here had joined a broader M&E group, well, now it's you know, gross revenues now get lopped into that other group. So, you know, when you're thinking about this, consider those aspects as well when you're acquiring. So, you know, with that said, right, that was kind of a quick run through of our consolidated the Article 6.1 rules for how you do the consolidated revenue threshold in Article 6. I will kick it here to Carolyn to take us through how this affects the GLoBE rules in practicality, right, in practice and doing the math.
Yeah, so Article 6.1, as Justin said, dealt with how you determine your M&E group with respect to mergers and demergers that may have taken place throughout the year. Article 6.2 is going to provide rules on how to adjust your computation of GLoBE income or loss if you have an acquisition or disposition of a controlling interest in a constituent entity during the tax year. And Article 6.2 is going to provide modifications and clarifications to the operation of these GLoBE rules, so that way we produce a smooth separation of the target from the seller and a smooth integration of that target into the acquiring group. So there are a number of provisions throughout Article 6.2 that deal with how we perform those adjustments. So first, a target is going to be treated as a member of a group for GLoBE purposes if its activity is included in the consolidated financial statements of the UPE in the acquisition year, And that M&E group, the acquiring M&E group, is only going to consider the amounts included therein. So in practice, it is likely that a portion of the target's entity's income and expenses are going to be included in the consolidated financial statements of the disposing M&E group based on the period that it was a member of that group. And this rule is going to follow the general approach of the GLoBE rules to rely on amounts reflected in the financials that are used in preparation of the consolidated financial statements. Additionally, in the acquisition year and each succeeding year, the target is going to determine its GLoBE income or loss and adjusted covered taxes using the historical carrying value of the assets and liabilities. So an M&E group that acquires a controlling interest in a constituent entity is to ignore the effect of purchase accounting consolidated adjustments that are attributable to the acquisition. So the result is there's not going to be any change in carrying value of a target's assets and liabilities when determining GLoBE income or loss. In other words, that step up that you might achieve in the carrying value of your assets and your intangibles is going to be ignored. So adjustments need to be made irrespective of whether this controlling interest in a constituent entity was acquired before the GLoBE rules were enacted. But practically, the commentary provides an exception if the acquisition occurred prior to December 1st of 2021, and the M&E group does not have sufficient records of that acquisition to determine the income or loss based on that unadjusted carrying value. They may use the carrying value, and special consideration should be given to deferred tax assets and liabilities of the target. The third bullet here, so eligible payroll costs are going to include only those reflected in the consolidated financial statements, and eligible tangible assets are going to be adjusted to correspond with the length of time that the target was a member of the M&E group. So eligible payroll costs and eligible tangible assets, hopefully these buzzwords you guys recall as inputs for our substance-based income exclusion that we calculate as part of our routine profits test, which is one of the safe harbor tests. And these eligible payroll costs and tangible assets, if we don't have this adjustment, they could be overstated with respect to the disposing entity or the acquiring entity. Additionally, the acquiring M&E group is going to include deferred tax assets and liabilities of the constituent entity required, and they may need to reverse any adjustments made to deferred tax liabilities that were completed previously by the disposing M&E group. And finally, if the target is a parent entity of another M&E group, the income inclusion charging mechanism, the income inclusion rule, should apply separately to its allocable shares of top-up tax. So what this means is special rules are going to be required to determine whether that target should apply the income inclusion rule for all or part of a year, because the application of the income inclusion rule by the target depends on whether the controlling interest is held by a group that is subject to a qualified IIR. The target is going to apply the IIR separately to its allocable shares of top-up tax in the low tax constituent entities that are determined for each group. So I think that is a pretty good overview of the adjustments that need to be made to the computation of GLoBE income and loss when we're acquiring or disposing of an entity. And that's under Article 6.2.1. Here, Article 6.2.2 is going to provide an exception to those rules to provide consistent treatment to dispositions of assets and liabilities, regardless of the form of the transaction. So in these circumstances, an acquisition or disposition of a controlling interest may be treated as the acquisition or disposal of assets and liabilities if the jurisdiction in which that constituent entity is located treats that disposition of assets and liabilities, and it will impose a covered tax on the seller on the difference between the consideration received or fair value and the tax basis. So as a result of this treatment, gain or loss on the transfer is going to be treated as a sale of assets or liabilities, is going to be included in the disposing M&E group's effective tax rate computation for that jurisdiction, another one of our safe harbor tests, that is imposed, that treatment to treat it as a sale of assets or liabilities. for local tax purposes. This is also going to apply to acquisitions of ownership interests, which following the transaction, the acquirer controls the constituent entity. I think here that'll take us to our third polling question. Let's see, I think if I go to our Q&A here while we wait on that, it looks like someone had a question about an example from the demerger example. Group B is no longer in scope, presuming it stands alone. Yes, I think we did cover that, presuming that Group B would not be going to not be a constituent entity of another M&E group. Yes, that's correct. Okay, so now moving right along to Article 6.3, which deals with the transfers of assets and liabilities. So Article 6.3 is going to provide rules for the gain and loss, for computing gain and loss, and how to determine the carrying value of assets and liabilities for acquisitions and dispositions of assets and liabilities where the seller may not be subject to tax on the gain in whole or in part. And we're going to look at these under two lenses because there's two different types of treatment for acquisitions and disposals of assets and liabilities in the ordinary course of business, and those that are done in connection with a GLoBE reorganization, which we're going to define in a later slide. So transfer of assets and liabilities, what is the impact to the GLoBE income or loss computation if this transfer is completed in the ordinary course of business? So the disposing constituent entity is going to include the gain or loss in its GLoBE income or loss, and the acquiring constituent entity will determine its GLoBE income or loss based on the carrying value, the acquiring constituent entity's carrying value of the assets and liabilities that are determined under an accounting standard used preparing the consolidated financial statements. So these rules apply to dispositions made in the ordinary course of business. The carrying value is based on fair value to the extent gain or loss on the acquisition was included in the income or loss of the selling group, and the fair value must be used to compute the acquiring entity's GLoBE income or loss, regardless of whether fair value adjustments are reflected in that M&E group's consolidated financials. We do want to call attention to transactions between related parties. The arm's length principle is going to apply regardless of whether that M&E group accounts for transactions at carrying value rather than fair value. So there could be additional administrative burdens associated with transactions between related parties and calculating your GLoBE income or loss reflective of those. The next section talks about transfers of assets and liabilities that are completed in connection with a GLoBE reorganization. So a GLoBE reorganization is defined in Article 6.3.2 as a transformation or transfer of assets and liabilities in a transaction. It could be a merger, demerger, liquidation, or similar transaction where the consideration received for those assets and liabilities is comprised of equity interests issued by the acquiring constituent entity or equity interests of the target. The disposing constituent entity's gain or loss is not subject to tax in their jurisdiction, and the tax laws of the jurisdiction of the acquiring constituent entity require taxable income to be computed after the disposition or acquisition using the disposing constituent entity's tax basis in the assets. So what Article 6.3.2 is really trying to do is align the GLoBE rules with the tax deferral treatment of certain reorganizations under the various jurisdiction local tax laws. So in contrast to how we treat disposals and transfers of assets and liabilities in the ordinary course of business, under a GLoBE reorganization, the disposing constituent entity is not going to include the gain or loss from the disposition in their computation of their GLoBE income or loss, and the acquiring constituent entity is going to determine the carrying value of the assets and liability using the disposing entity's carrying value. So there are certain situations where some gain or loss does not qualify for non-recognition treatment in a disposing constituent entity's jurisdiction, and the OECD refers to this as non-qualifying gain or loss. So if a disposition that as part of a GLoBE reorganization results in a constituent entity recognizing non-qualifying gain or loss. The effect is that the disposing constituent entity will include the gain or loss on that disposition in their GLoBE income or loss, and the acquiring constituent entity will use the disposing entity's carrying value of the assets or liabilities consistent with local tax rules in computing their GLoBE income or loss. Finally, going to move pretty quickly through this last section here so that we can get to our elections and our comprehensive example. But I wanted to touch on the fair value adjustment election under Article 6.3.4. So a constituent entity may be required or permitted to adjust the tax basis of their assets or liabilities. This is commonly seen, for example, in a situation where exit tax is assessed on a cross-border reorganization. This article will provide an election for a constituent entity or its owners to adjust the tax basis of assets and liabilities to align with local tax law. And this is just going to provide a little bit of administrative relief in the accounting processes when computing GLoBE income or loss. So with that, I think Justin is going to take us through the next section, going through a brief refresher of our elections and then our comprehensive example.
Yeah, and before we chime in on that, I do want to emphasize, right? I think one of the big, when you're thinking about the transfers of assets and liabilities, right, and you're thinking about, selling an entity or buying an entity in the context of Pillar 2, one of the big things that, from a pragmatic and practicality standpoint, that stands out when you're assessing, the M&A ramifications of Pillar 2 is you'll notice that a lot of the provisions are centered in on this idea of historical carrying value, right? And not, that's a little bit of a for lack of a better word, taboo type way of assessing a transaction, because most of the time we're thinking about things like purchase price accounting, right, and push down accounting in the U.S. GAAP context. And historical carrying value is, for all sakes and purposes in the GLoBE rules, really thinking about what that cost is, when you scrap out a lot of that. And we know purchase price accounting has its own ripple effects when you're applying the transitional CBCR safe harbor and applying the qualified financial statements aspect of that. So, I do want to direct our audience to the notion that a lot of this is premised on the historical carrying value. So, without, minus my little chat about that after there, let's talk a little bit about Pillar 2 election. So, when you're, Pillar 2, like any new different tax regime, has its own formal set of multiple elections, right? And in a prior session, we went through almost, I'd like to think almost all. There have been some that have been thrown out in there in administrative guidance, so we'll look into refreshing that segment going forward. But this is kind of an overview of some of the various different elections that are thrown around that taxpayers and M&E groups can make elections for, that affect Articles 1, Articles 3, 4 for GLoBE income and covered taxes, and even Article 6 in some cases. And technically the safe harbors that we've had are different, are elective as well for Pillar 2 compliance. So we're gonna choose a couple of these here and just kind of a recap of them, because some of these have big ripple effects in the Pillar 2 realm when you are in this space where you're selling or acquiring assets and liabilities. So there is this fair, one of them I'm going to pick on, that we're going to pick on 3 of them, and there's plenty of them in there, but for time's sake, we don't have all the time in the world to that. So, and we all have your time is valuable, so we're going to kind of pick and choose here for some of the ones that we want to think about. So Article 6.3.4 basically provides an election that says, GLoBE income or loss earned from the sale of an asset, right? And what it goes in on is, it basically allows an entity of an M&E group to adjust the basis of its assets and liabilities to fair value for tax purposes only in the jurisdiction in which it is located. And this is kind of a deviation from that historical carrying value. It does not apply to ordinary sales of assets like inventory by a constituent entity or transfer pricing adjustments. And if an election is made in this article in connection with the acquisition of a controlling interest in a constituent entity that is governed by Article 6.2.1, the election does not affect the application of 3.2.1C to the seller. So 3.2.1C is basically the piece that says that you exclude equity gains or losses from your GLoBE calculation. So, what happens when you make the selection? Well, when it's made, the constituent entity recognizes gain or loss and adjusts its carrying value of its assets and liabilities for purpose of the GLoBE rules to the fair value for tax purposes. How this usually works, right? It's you would file this on the GLoBE information return for the jurisdiction where you're seeking this election. And what happens when you do that is that the total net income or loss is split equally over 5 subsequent fiscal years unless that constituent entity leaves the M&E group, and there's basically a recapture amount that it'll be picked up in that year in which that constituent entity leaves the group. So something like this is something to consider if you are in the process of acquiring, or you want to or selling. Like this could potentially skew some of the Article 3 GLoBE income ramifications and help kind of contain some gain or loss when you're calculating, doing the formal calculation that's enumerated in Articles 3, 4, and 5. So that's one piece we want to talk through. The second one here is the aggregate asset gain election. This is found in Article 3.2.6, and basically what it says is, let's say I sell local tangible assets, basically like PP&E, right, or something like that. It permits an M&E group to spread the gains and losses of that from the sale of those assets for a period of up to 5 years to mitigate the effects of recognizing that gain in one single year, right? Because maybe the gain's so large that it dilutes the base of the jurisdictional ETR and trips up top-up tax. So, we've seen this in practice is, the gain's large, and so one thing to mention is there are ordering rules in the consolidated GLoBE commentaries on how you apply that, how you spread that gain. And a certain pecking order that was discussed in the prior session. But when you're thinking about this, you want to think about how will it be able to keep your ETR, right? Where we see it most preferable is where it keeps your ETR above the 15% because of that gain that's being picked in. So it's something to consider, and some of our recent clients that are very acquisitive, right? It's at in the other case, in the process of selling off entities, this has helped kind of contain some of the Pillar 2 impact that will be happening in the coming years. Overall, this provides an ability to mitigate lopsided top-up tax exposure, right? And the policy behind this that the OECD relies on is they say this matches the increase in value of the asset that's likely to accumulate over a period of years, as opposed to one, right? Because while it would be fine to pick it up all in 1 year, you usually see those assets through depreciation and all those other pieces, right? They've been done over a period of time, right? So this is kind of marrying up to the reality of acquiring a local tangible asset. One thing to consider there, and this is an annual election. It's made on a jurisdictional basis, and it can be combined with the Article 3.2.5 fair value or impairment accounting election that's done in the consolidated financial statements, right? So what that article says is that a filing constituent entity can elect to determine gains or losses using the realization principle for purposes of computing GLoBE. So that's another election here that we've seen pretty beneficial in the context of this conversation. And then there's the equity investment inclusion election, right? And this one is really what we find to be a really helpful one, right? And we're going to use an example here to take this, to put this into action. But it basically, so Article 3.2.1c says you exclude equity gains and losses. Basically when you sell stock of a company, you exclude that from GLoBE income, right? Any gain on that. And any taxes on that. We're going to give an example how this works practically, but this election allows, we'll call it the EIIE election, or the EIIE, right? This election allows for you to, instead of excluding the equity gains or loss for purposes of GLoBE purposes, to actually include it, right? And why would you want to do that, right? You would want to probably, there's a corresponding adjustment when you exclude the income. You also have to exclude the taxes too, right? Under Article 4, matching the income with the tax, right? That's the premise that Pillar 2 is really getting at. So what we've seen is that this could be very beneficial where you have where you need a little bit of tax to get you over the hump of the Pillar 2 threshold, right? That's tax that you've already paid in a jurisdiction, and now you could be subject to additional tax because of the Pillar 2 regime and this Article 3.2.1c exclusion for equity gains or losses. So, its biggest impact, right? It impacts and it basically allows you to include that in there. So the procedure for this, and in the interest of time, we'll go through this here and then go to the last polling question. It's a 5-year election, and it applies on a jurisdictional basis to all ownership interests owned by the constituent entity. And once it's done, it cannot be revoked in regards to an ownership interest lost. So let's go through a quick example, and then we'll do the last polling question in the interest of time. So let's say I got a U.S. parent company that owns a UK CFC, right, a constituent entity, and a U.S. buyer comes in and wants to purchase the UK constituent entity. So from a U.S. tax perspective, right, you might have some 1248 gain or loss because it's a CFC. To the extent of any accumulated EMP, you apply your 959 PTEP rules, and then any untaxed EMP distributions could be offset potentially by 245A's DRD on that. If you have any treaty resource income, the foreign taxes paid on that could basically make it creditable under 901, right? And any residual gain is subject to tax on 21%. That's the U.S. side, right? What the effect on Pillar 2 is, Article 3.2.1c will say, hey, this gain is not included in your Pillar 2 calc, and neither are the taxes, right? Because matching the income and the taxes together. Well, if the seller, so the seller here can make an election under 6.3.4 to include those gains or losses in GLoBE income and related covered taxes. That's what this the IEEI, or the investment equity election, basically overrides 3.2.1c to allow the seller to include that gain in taxes and hopefully help its Pillar 2, right? Calculation for that jurisdiction. The seller, the U.S. parent company, is no longer within the scope of Pillar 2 after this example, right? Depending on how it works, and you could technically form a new M&E group if the U.S. buyer could, if that revenue threshold exceeds 750 million euro, and that's applying the 6.1.1 rules we talked about when you're doing the consolidated revenue threshold test. So I think we're here at time, so we're going to give this last polling question here. And I think here we're at the tail end of the final polling questions here. So looks like all of the above there was the common answer here. So I know we went above 2 minutes here, so we apologize for running a little bit delayed here. So this is the tail end of our presentation. We'd like to say thank you. We know your time is valuable, And we really really do appreciate you taking time out of your busy day to come in and tune in to our Pillar 2 session. So as we're going into the last session of this 10-part series, we do want to say thank you for those that have tuned in. And please stay tuned for the next segment. We are working on another comprehensive segment that dives in a little more into the Pillar 2 rules in a more granular fashion. So stay tuned, and this definitely will not be the last time you hear from us. So thank you, and have a nice day.